Hello, everybody. Thank you so much for joining us on today's BRICSonomics show here on the BRICS Business YouTube channel that is powered by Think BRICS. I'm very happy that you guys are going to be joining us today. We are going to be continuing to expand our knowledge and understanding about the United States-Israel-Iran war. And we're going to look at the war from the dimensions of the corridors, the sort of economic development corridors that are really being affected by this crisis. We're going to go into a deep dive on the impact of what those corridors provided to the nations in that area and how the war has impacted, that economic activity. But we're also going to discuss some recent news. Now, it may be speculation, it may not be. It was believed that Iranian's foreign minister would charge a $2 million toll to pass through the Hormuz Strait on the assumption that you are, not diplomatically or politically aligned with the United States or Israel in this case. So I kind of got to thinking about this. So how would this sort of 2 million toll work? Not just for the sake of Iran itself, but to its allies, but also for nations that are very much impacted by the the pausing of the Hormuz Strait, as we'll call it, and how it may impact economies, as it evolves. So if you guys have any suggestions on what dimension to sort of look at this conflict in, or if you guys have, suggestions for new topics that you want us to cover, please drop them in the comment section because we actively go through those and we actively use your guys' thoughts and opinions into forming these episodes. Okay, so without further ado, guys, let's dig into how the major corridors are going to be affected here by the war between the United States and Iran. So here in this slide, this is sort of this is sort of a map that's going to be the 10,000 foot structure of the global trade system now that has been under stress because of this current war between the United States and Iran. And right now here, you guys can see that the thickest lines are linked to Hormuz-linked Gulf, Asian, Europe trading routes. So in 2024, early 2024-25, about 20 to 21 million barrels of oil per day transitions through the Hormuz Strait. So, and it represents about 1/4 of all seaborne oil trade and about 1/5 of global oil consumption. 80% of that oil is going to Asia, mainly countries like China, India, Japan, and South Korea. And this is why the Hormuz line on the map here should look like sort of a main artery of this global trade system. So just below that, we see the India, Middle East, Europe economic corridor, as well as what we see here, the Red Sea, which is the Bab el-Mandeb Suez corridor, which connects Asia and the Gulf to Europe. So historically, the Suez Red Sea route has handled a large share of Asia-Europe container trade. So when the Suez was blocked in 2021, more than 5% of global container shipping was delayed. And some flows were forced to obviously go around the Cape of Good Hope, which adds, as much as a week for these voyages. So, and then you'll see here up to the north, Central Asia's southern corridors via Iran tie a lot of these landlocked economies like Kazakhstan, Uzbekistan, Turkmenistan to Persian Gulf and Indian Ocean ports. So we could see these routes are sort of these escape valves, right, that allow Central Asia to diversify away from, dependence on countries like in Russia, for example, and forming their own diversified economy. So this route is incredibly important to them for their own diversification. And then finally, we have the Gulf to Africa and Gulf to Southeast Asia rail here, or the route, which sort of illustrates how much of Africa and Southeast Asia's energy and their manufactured import needs are met via these Gulf ports and refineries. And this matters right now, obviously, given the conflict. So, like, if we think historically, we can tie this to like the Suez closures of 1956 and 67 to 75. There were a few choke points that forced ships thousands of kilometers around Africa, effectively cutting global shipping capacity by about 20%. And it really, as a result, spiked freight rates. So today we're seeing a similar concentration of flows here in, the Hormuz, the Red Sea, and a handful of other land corridors, which means that this localized conflict in this area, again, is becoming a global trade and energy risk amplifier, and how it's going to affect economies right now moving forward. So now if we sort of want to zoom in on this map and make a composition of trade along these corridors, it'll give us an idea of the impact and what each corridor provides for not just economies, but also industries in BRICS and the global south areas. So we've talked about the Hormuz linked routes, right? Dominated by 20 million barrels of oil a day. You know, 15 million barrels of that is crude, 5 million is refined like diesel and jet fuel. And obviously, 1/5 of global LNG trade also goes through the Hormuz, primarily from Qatar, which obviously has been hit as part of this conflict. So added to this are fertilizers, and fertilizers have been discussed a lot as going to be really impacted with this conflict. So the UN Center for Trade and Development estimates that roughly 1/3 of global seaborne fertilizer trade passes through the Hormuz Strait, which is around 16 million tons of fertilizer goes through this strait. So by contrast, we see the India Middle East corridor, I'm just going to call it IMEC, and the Red Sea routes are dominated by these containerized goods. So electronics, textiles, machinery, auto parts, and other intermediate inputs. And so when the Red Sea crisis flared, container rates on Asia and Europe routes jumped by $100 to a few $1,000 per TEU, which mirrored a lot of the disruptions we were previously discussing on the Suez Canal. So if we talk about the Central Asia southern routes and the Gulf to Asia and the Southeast Asia corridors, they combining the energy exports with the agro industrial flows like grain, edible oils, fertilizer, like we talked about, and light manufactured goods moving south and east, with food and manufactured imports moving back. So right now, when we're looking at sort of the intersection of these corridors and stacks, we see right away that China and India together absorb a lot of the majority of the Hormuz oil that is going through the strait, while the ASEAN 5 and the African Union alliance states depend heavily on Red Sea and Gulf corridors for both fuel and containers. So when these corridors are disrupted, the first casualties are going to be the energy intensive industries, right? The agriculture and the electronics supply chains, precisely the sectors where, economies in BRICS and the global south have built a lot of their growth model on and have developed a lot of momentum on. So now this pie chart here is just showing how much global trade rides on these two choke points. So on the Hormuz, when we talk about how, 20% of world oil consumption, like a quarter of seaborne oil trade goes through this strait, nearly 85% of crude and 5/6 of LNG go to Asia, dominated by China, India, Japan, and South Korea. And then we see here on the right, of the Red Sea and the Suez pie chart, where Asia, Europe, and Asia, Africa trades dominate this pie. And when the Suez Canal was blocked in 2021, more than 5% of that global container shipping was delayed. So that, adding an extra 8,500 nautical miles to a Far East Europe trip, or about an extra 10 to 14 days of sailing, we're going to see that how that really amplified the effects on their economy. So let's talk about the elasticity estimates. It'll give us sort of the stakes from macroeconomic perspective. So, for example, we've seen Indian analysts estimate that for every $10 increase, $10 United States dollar increase in oil prices, it could shave off about a quarter percentage point off of India's GDP growth because of India's heavy dependence on crude from the Middle East. And similar work that Goldman Sachs has done has suggested that a $10 rise in oil would trim the United States' GDP growth by, a quarter percentage point. Now, GDP is not a perfect measure, obviously, but for the sake of energy, GDP is going to basically represent what a country produces a year. So that's why I'm using the GDP growth for this. So now if we combine the elasticities that we just discussed with the fact that, a quarter of oil, share of oil trade goes through the Hormuz Strait, and that a large fraction of Asia, Europe container flows are concentrated in the Red Sea, the risk is not only large, but it is highly focused on economies that rely on these corridors. So now let's kind of go through the social. I want to sort of break down the social and demographic profile at the end of each of these corridors, because we want to see where the goods from these routes are going. How is it going to impact the people that it's going to be delivered to? So let's look at these Hormuz linked routes first. So the main exposed populations are in the Gulf states. So we have high income, heavily urbanized, energy exporting societies, and Asian importers whose manufacturing and transport depend on Gulf fuels. So think of Riyadh or Dubai on the supply side, where Mumbai, Shanghai, or Osaka are on the demand side. So if we go to the IMEC linked and the Red Sea linked routes, exposure is very much concentrated in these rapidly urbanizing, manufacturing led, energy importing regions. So India's urbanization is just above 36%. Much of ASEAN sits in the 50 to 60% range. And many African economies are in the 40 to 50% band. Yet manufacturing share of GDP is still climbing, and energy import dependence remains very high. Now, for Central Asia's southern routes, they map onto these landlocked resource exporting, relatively low urbanization economies within Central Asia. So historically, these countries have relied heavily on imports from Russia before as they became independent. But diversification through Iran and the Gulf is their modern attempt to sort of diversify themselves more. So the intended markets for these corridors are young, urban, manufacturing intensive societies. And those are the same markets that are actively exposed in 2025 to 2026. So when energy prices or freight costs spike, it is the urban households and the factory workers and the small exporters in cities in the global south and BRICS who feel it first. And like when there was the oil shocks in the 1970s and these rapidly industrializing economies like Japan were suddenly forced to adapt to these sharp rise in energy costs, today we're seeing an equivalent shock hit Mumbai and Lagos and Sao Paulo and Jakarta. So now let's talk about how these nations are going to be diversifying their economies because of this war and what their strategies are going to be here. So you could see that the red and blue lines show that the Hormuz and the Red Sea routes still carry the majority of flows for BRICS and global South trade. But the green and the orange routes, or the green and the orange lines, the the INSTC, the middle corridor, and various BRI linked land and sea routes are rising from a low base. Since around 2020, BRICS and many countries in the global south have heavily invested in rail, road, and alternative port infrastructure to reduce dependence on United States centric finance and on the two big maritime choke points. As of 2025, these alternative corridors probably handle about 5 to 10% of BRICS linked trade only 5 to 10%. But published strategies and feasibility studies, envisage reaching 15 to 20% by 2030. But it is obviously going to be conditional on the financing and the political coordination to do so. So, it's a means of obviously reducing their own system's fragility that they rely on. So when Europe and Japan had to heavily invested in strategic stockpiles and pipeline networks after the shocks in the 1970s, this is sort of a similar thought process. So in the modeling later, these diversification efforts act as dampening factors. So they're going to reduce the elasticity of GDP and trade flows to a Hormuz shutdown or toll regime, especially for countries that have already shifted part of their flows away from these vulnerable corridors. So now I want to discuss sort of the econometric framework that we should be thinking of, how these costs are passing through these corridors, and from these trade choke points are impacting not just economies but people. So first here on this side, it has the gravity type panel models. Now there are meta estimates that suggest about a 10% increase in trade costs can reduce bilateral trade by roughly 7 to 12%, depending on the distance of the trade partner, the income, and the institutional quality. When applied to a world where freight rates on Asia and Europe routes have jumped by $2,000 to over $4,000 a container due to the disruptions in the Red Sea, and the rerouting around Africa, which adds about 300 or more USD dollars per box in these operating costs, you can see how these temporary shocks have very large volume effects. Now, second here is the structural DSGE type, which means dynamic stochastic general equilibrium type, and it's just a specific type of econometric model that we use for simulations. Now, DSGE models do have their limitations, but they are important to use sort of as a base, knowing those limitations. So those models, but also the VAR models, which are stress testers of energy-related shocks. So for central bank and bank research suggesting that a 20% oil price increase can shave half to over 1.5 percentage points off of global GDP growth a year, with larger impacts on energy intensive developing economies. that these models are very important to measure these shocks. So third for this framework is this, we need to think of a multi-country input-output model. And we want to design it like this because we want to see how these shocks propagate. And we notice that, like, for example, higher energy and freight costs not just hit refineries and shipping, for example, but they also hit petrochemicals, fertilizers, transport, electronics manufacturing, which amplifies the macroeconomic impact that we see. And you could think of it sort of as this circulatory system where a partial blockage in like an artery, if we call the Hormuz or the Red Sea one, it doesn't just slow the blood in that artery. It forces the heart to pump harder, and it reroutes these flows, which stresses other parts of the system. So for countries in the global south, in this case, or countries that are members of BRICS, who, for the most part, are more energy intensive and less diversified, that stress is going to show up as larger elasticities and deeper dips in growth potentially. But now I want to sort of make this more complicated for us. And the reason I want to do this is because one issue with DSGE models is that they assume that our markets hit a sort of equilibrium, or that's sort of the expected outcome. But a lot of research has shown, especially within the last 20 to 30 years, is that we don't even necessarily hit an equilibrium at all. So how do we see the shift from how much output is lost to who bears the loss through which financial channels here? So if we think about this framework from completely eliminating an assumption of equilibrium, this energy price shock does not simply move us to a new equilibrium point. It'll hit a new price here and a new supply here. It shifts income and shifts balance sheet positions over time. So when oil and freight prices rise, we're going to see nominal wages typically adjust slowly. So real wage shares fall and domestic demand weakens in these wage-dependent economies. But on the profit side, these energy exporters' profit shares can rise, while energy importing manufacturers could see their margins being squeezed as a result, especially if their currency depreciation raises the local currency cost of these imported inputs. So now the financial channel is going to add another layer to this, because the higher import bills and trade disruption we have will have wider current account deficits and can raise currency risk, and sovereign risk premia, which is like investing in U.S. treasuries, for example, or Chinese or Indian bonds from the central bank. It can trigger a credit squeeze for these firms that are exposed to these global value chains. So this was visible after the oil price shocks, or after past oil price spikes, when several emerging markets that were experiencing currency crises and debt servicing stress rather than just slower growth. So I know that was really complicated. So I'm going to restate that previous point a little bit clearer. The financial channel adds another layer: higher import bills and trade disruption, which can widen current account deficits. It can raise currency risk and sovereign risk premia, which can trigger a credit squeeze for firms that are exposed to these global value chains. So this was visible after past oil price shocks, when several emerging markets that are, they experience currency crisis and debt servicing stress rather than just slower growth. So in today's context, we're seeing governments, many around the world, they're already carrying a lot of United States denominated debt, and banks are heavily exposed to trade related sectors. So a Hormuz or Red Sea induced energy shock can evolve from a cost push problem into a distributional and financial stability problem. And this is, this is a much more dynamic and quite different solution that normally economists that focus on equilibrium will say that it'll mainly focus on inflation. It's not just going to be inflation. It is going to evolve itself into a problem of wealth and income distribution, but also financial stability. So you could think of it as, a parking jam, even where, if neoclassical economics and assuming equilibrium, they would think that this shock is basically just a brief halt in the system. So it's a temporary shock. But I think for us, it's important to think of this as a permanent reroute traffic through these weaker roads because of the impact that this conflict has. It will change. It is changing the calculus of these nations, understandably so, completely. So now let's sort of discuss this recent news about Iran supposedly going to charge $2 million for ships to pass through the Hormuz Strait. Now, this is not an official policy of Iran. This is something that was quoted by their foreign minister, not verified though. So I want you to take this 2 million ship toll on the Hormuz with a grain of salt. But the reason that I want to focus on this is because there will be, we're seeing a system evolve where Iran is giving passage to nations that are not, that are not aligned with the United States and Israel on this conflict, for example. So it begs the question that, if they basically, if they are going to willingly charge $2 million per vessel, how would that evolve over time for economies, not just that are dependent on the Hormuz Strait, but also the United States that will still be blocked from it? So using the elasticities that I mentioned earlier and the official 2024-2025 flow data, such as a toll, is broadly equivalent to 15 to 30% increase in delivered energy prices and a 10 to 15% increase in freight costs for these affected routes. Now, the exact number depends on obviously the vessel size, the cargo type, and whether the cargo owners are going to just pass on the toll or actually absorb it. So in this first column here, it's going to show the hypothetical of like a complete closure of the Hormuz Strait, for instance, where everything needs to be rerouted via pipelines and other routes. The second column is a full rerouting via the Cape of Good Hope and alternative corridors, which would add about 10 to 14 days to Asia-Europe voyages and obviously significantly raise capital and fuel costs. Now, the third scenario is our toll scenario, which lies in between. Some traffic pays the toll and keeps the shorter route. Some avoid the political risk or fees and don't. Now, for economies in the global south, based off of my calibrations and the simulation we did, this scenario would reduce annual GDP growth for these economies by roughly 0.5 to 2 percentage points over 1 to 2 years. But it depends on their energy intensity, their import dependence, and their debt burden. And, if we kind of go back to the 1973-74 oil shock and the Suez closures, for example, it's not a complete embargo, but it's a pricing of passage that is going to redistribute the rents and forces selective rerouting. So paying the toll doesn't neutralize the shock. It sort of transforms the shock into a direct transfer to Iran in this case, while the combination of higher prices, rerouting, and the uncertainty creates will depress activity. Now, so when we quantify how the toll and the rerouting scenario is going to affect wages and profits and financial risks, we could see that, in this first panel, it shows that empirical episodes in which higher oil prices are associated with falling wage shares, especially in economies with weak collective bargaining, which is, bargaining power, or wage indexation. Real wages fall as fuel and food costs rise faster than nominal pay, which is going to pull down consumption in these lower and middle income households. The second panel plots the profit shares against shipping cost shocks. And we can see here that import dependent manufacturers see margins compressed when a freight and input costs rise. Now, energy exporters, by contrast, will often enjoy windfall gains, a pattern that is often observed in these past Gulf conflicts and oil shocks. And this third panel, it links the trade shock severity to the currency and sovereign risk premia. So as import bills rise and trade flows become more volatile, lenders demand higher spreads, right? And in previous episodes, this has led to currency depreciation, higher external borrowing costs, tighter domestic credit markets, especially in emerging markets. So when you overlay these three channels on the GDP loss estimates from this toll scenario, the picture for, economies in BRICS and global south is sobering. Real wages are going to fall, profit share and key non-energy sectors are going to be squeezed, and borrowing costs are going to rise all at once. So for policy responses, they therefore need to go beyond rate cuts or generic fiscal stimulus, right? This needs targeted transfers, wage support mechanisms, debt relief or reprofiling, macroprudential tools to mitigate the currency risk that we're seeing here, and an accelerated investment in alternative corridors and domestic energy diversification. Okay, so to wrap this up, everybody, we're going to bring together the empirical and the theoretical strands. So empirically, we saw that the Hormuz carries around 1/4 of global seaborne oil trade and about 1/5 of global oil consumption, with about 80% of that going to Asia. The Red Sea Suez route carries a large share of Asia-Europe and Asia-Africa container flows. And rerouting around Africa adds 8,500 nautical miles and up to 2 weeks to very key voyages. So my econometric estimates suggest that 15 to 30% energy price shocks and a 10 to 15% freight cost shock can reduce the GDP growth by half to up to about 2 percentage points in economies that are highly exposed to these corridors. So these shocks are going to redistribute income between wages and profits. I guess I could say these shocks will reduce income between wages and profits. And they're also going to raise currency and financial risk, especially in economies that are highly exposed to these corridors, like I previously mentioned, but also ones that are heavily indebted to United States dollars, denominated currency. So I think for the policy conclusion here, it's twofold. First, it's corridor diversification. So we talk about the NSTC Middle East corridor, regional port upgrades. It's not a luxury anymore. It's now being formed as a sort of systematic insurance. And second, distribution sensitive and financial aware stabilization, such as protecting real wages where possible, managing exchange rate risk, and addressing a lot of these debt vulnerabilities is essential to prevent an energy logistics shock to becoming a full-blown economic development crisis. So in that sense, Hormuz control and tolling are not only matters of, you could argue, not are only matters of security or oil pricing. You could argue they are development channel related issues that are going to determine the gains and the pains of how globalization are distributed between the global north and south through these corridors, and how the disruption of these corridors are going to affect these economies that rely on them that much more. So for us, for you, the audience that want to do this too at home, who want to look at these challenges, the real challenge is to measure these effects accurately. The policy challenge is to ensure that economies are in the global south or in BRICS or developing, what have you, are not left to absorb these shocks alone. So that is going to be the conclusion of this presentation, guys. I hope you found this interesting in seeing how, what if Iran were to cause a certain toll, how that could affect, energy prices, but not simply energy prices, but also your economies in general. Because, like I always like to mention, it's not going to affect one sector alone, especially with energy and logistics related shocks. We see these effects, ripple across the economy altogether. So again, let me know what you guys think about this in the comments section. Would you like me to do another scenario? Is there something I didn't consider and maybe I should consider? And by always, guys, be sure to hit like and subscribe and let me know what you guys want us to talk about next.